The streets of Caracas awoke on the morning of January 16th to a silence that seemed heavier than usual. Across the city, residents checking their phones found themselves staring at news that would ripple far beyond the borders of Venezuela. American special forces, acting under orders that had been months in preparation, had executed a coordinated operation to seize control of key oil infrastructure facilities in the disputed Essequibo region and strategic points within Venezuelan territory itself. The official justification cited threats to regional stability, humanitarian concerns, and the protection of international energy interests. But beneath the diplomatic language and the carefully worded press releases lay a reality that would reshape the global economic landscape in ways that most observers were only beginning to comprehend. Within 72 hours of the operation, oil prices had surged by 38%, gold had broken through historic resistance levels, and currencies across emerging markets had entered a state of violent flux. Yet these immediate market reactions were merely the surface tremors of a much deeper seismic shift, one that historians may well regard as the moment when the architecture of global wealth distribution entered its most dramatic transformation since the dissolution of the Bretton Woods system in 1971. To understand why this single military action carries such profound economic implications, we must resist the temptation to view it as an isolated incident. Instead, we need to recognize it as the culmination of forces that have been building for decades, forces rooted in the very nature of how wealth moves through the international system. The operation in Venezuela represents something far more significant than a geopolitical maneuver or even a resource grab. It marks the visible fracturing of a financial order that has governed the planet for nearly 8 decades. And with that fracturing comes an inevitable redistribution of wealth on a scale that defies easy comprehension. The question is not whether a massive transfer of capital is underway, but rather who will emerge holding what remains when the dust settles. Venezuela sits atop the world's largest proven oil reserves, surpassing even Saudi Arabia, with an estimated 304 billion barrels. This geological fortune, however, has been largely stranded for years due to a combination of international sanctions, domestic mismanagement, and the deterioration of extraction infrastructure. The Essequibo region, which has been disputed between Venezuela and Guyana for over a century, recently revealed itself to be home to offshore oil deposits that could contain up to 11 billion barrels, transforming what was once a matter of national pride into a flashpoint of global significance. When American forces moved to secure these assets under the premise of establishing a stabilization zone, they did not merely occupy territory. They effectively severed one of the world's largest concentrations of hydrocarbon wealth from the control of a government that had positioned itself in direct opposition to Western economic interests, aligning instead with China, Russia, and Iran. The immediate consequence was predictable to anyone familiar with commodity markets. Oil futures contracts exploded in value as traders calculated the implications of removing Venezuelan supply from potential global markets, even though that supply had been largely offline for years. But the psychological impact mattered more than the physical barrels. Markets were forced to confront a new reality where resource nationalism could be answered, not with sanctions or diplomatic pressure, but with direct military intervention. This precedent sends shockwaves through every nation sitting on valuable natural resources while maintaining an independent foreign policy. If Venezuela today, then who tomorrow? To grasp why this moment carries such transformative power, we must journey back to another era when the global economic order underwent a similarly dramatic restructuring. In August of 1971, President Richard Nixon stood before television cameras and announced that the United States would no longer convert dollars to gold at the fixed rate of $35 per ounce. This decision, made unilaterally without consulting America's allies, effectively ended the Bretton Woods system that had governed international finance since the end of World War II. The implications were staggering. Overnight, the entire framework of international trade and currency valuation was thrown into uncertainty. Nations holding large dollar reserves watched as the value of those holdings became subject to market forces rather than guaranteed convertibility. The fixed exchange rate system that had provided stability for a generation simply ceased to exist. What followed that August announcement was not chaos, but rather a profound reorganization of global wealth. The 1970s saw a massive transfer of purchasing power from Western nations to oil-producing states in the Middle East as petroleum prices quadrupled during the oil shocks. Petrodollars flowed from consuming nations to producing nations, fundamentally altering the balance sheets of entire regions. Simultaneously, the transition to floating exchange rates meant that countries with weak fiscal positions saw their currencies collapse, effectively transferring wealth from domestic holders of that currency to foreign creditors and those holding harder assets. The decade became synonymous with stagflation in the West, but it was also a period of dramatic wealth accumulation for those positioned correctly, particularly in hard assets like real estate, precious metals, and energy infrastructure. The parallel to our current moment becomes clear when we examine the mechanics at play. Just as the Nixon shock represented the unilateral rewriting of international financial rules by the dominant power, the Venezuela operation represents a unilateral assertion of control over strategic resources. Both actions fundamentally undermined trust in the existing system. In 1971, the message was that America would no longer subordinate its domestic economic policy to the maintenance of dollar convertibility. In 2026, the message is that control over critical resources may ultimately be determined by military capability rather than sovereign rights or international law. Both moments forced global actors to reassess their assumptions about how the system actually works beneath the veneer of rules and institutions. The wealth transfer currently underway operates through several distinct but interconnected channels. First, there is the direct effect on commodity prices. When oil surges, wealth flows from consumers to producers, from importing nations to exporting nations, from individuals who must pay more at the pump to shareholders of energy companies. This transfer is mechanical and immediate. A sustained $20 increase in oil prices represents roughly $600 billion annually in additional costs for global consumers, money that flows directly into the coffers of producers. But the Venezuela situation adds complexity because it removes a potential future supplier from the market, effectively increasing the pricing power of remaining producers. Saudi Arabia, Russia, and American shale producers all see the value of their reserves increase, not just because current prices are higher. Second, the operation accelerates the fragmentation of the global economy into competing blocs, a process that has been gradually intensifying since the trade tensions of 2018. China and Russia have been working for years to establish alternative payment systems, alternative reserve currencies, and alternative frameworks for international trade that bypass Western-controlled institutions. The Venezuela raid provides powerful ammunition for their argument that no nation can trust its sovereignty or its resources will be respected if it runs afoul of Western strategic interests. This drives more countries toward alternative arrangements, which in turn weakens the network effects that have made the dollar dominant. As the dollar's role as the universal medium of exchange erodes, so too does America's ability to finance its deficits at minimal cost. This represents a transfer of wealth from the United States to nations that have accumulated dollar reserves, as those reserves will command less purchasing power, but it simultaneously transfers wealth to those who have positioned themselves in the new alternative systems being constructed. Third, the uncertainty generated by such a dramatic action drives capital flows toward perceived safety. Gold has historically served this function, and its price surge in the wake of the operation reflects this flight to safety. But what constitutes safety is itself being redefined. For decades, United States Treasury bonds represented the ultimate safe haven, the asset you held when everything else seemed risky. The Venezuela operation, by demonstrating a willingness to use military force to reshape economic realities, introduces a new variable into the calculus. If property rights and sovereign control can be overridden by military power, then the promise embedded in a financial instrument from any government becomes contingent on that government's military strength and willingness to honor commitments under stress. This realization drives wealth toward tangible assets, toward things that cannot be printed or promised away, creating tremendous tailwinds for commodities, real estate, and other physical stores of value. The historical precedent that perhaps best illuminates our current trajectory is not the Nixon shock alone, but rather the broader transition that occurred in the 15 years following World War II. The Bretton Woods Conference of 1944 established the dollar as the world's reserve currency. Backed by gold and supported by America's overwhelming economic and military dominance. This arrangement was not simply agreed to through negotiation. It reflected the reality of America held roughly 2/3 of the world's monetary gold. Its industrial base was intact, while Europe and Asia lay in ruins, and its military strength was unmatched. The dollar became the global currency because there was no realistic alternative, and the system worked as long as American power remained overwhelming and American policy remained relatively predictable. The breakdown of Bretton Woods occurred when these conditions eroded. America's gold reserves dwindled as persistent trade deficits led to dollar outflows that were converted to gold by foreign central banks. The Vietnam War and Great Society programs created inflation that made the fixed gold price unsustainable. Other economies, particularly Germany and Japan, recovered and began to challenge American industrial dominance. The system collapsed because the underlying power dynamics that supported it had shifted. The current dollar-dominated system faces similar pressures. America's share of global GDP has fallen from nearly 40% in the immediate post-war period to roughly 24% today. China has emerged as a manufacturing powerhouse and is increasingly asserting itself in its region. The fiscal trajectory of the United States, with debt approaching 135% of GDP and deficits that seem structurally embedded, raises questions about long-term sustainability. The Venezuela operation can be understood as an attempt to arrest this decline through the assertion of raw power. If economic dominance is slipping, military dominance remains intact, and that military power can be used to secure strategic resources and deny them to rivals. This is not a new strategy in human history. The British Empire maintained its position long after its relative economic decline had begun through superior naval power that controlled trade routes and access to resources. Rome continued to dominate the Mediterranean world for centuries through military might, even as the economic vitality of its core territories waned. But these historical examples also illustrate the limitations of such an approach. Military dominance can slow decline and redistribute wealth through conquest, but it cannot indefinitely substitute for genuine economic productivity and innovation. What makes the current wealth transfer potentially the largest in history is the sheer scale of assets now at stake and the speed with which value can move in modern financial markets. In 1971, it took years for the full implications of the Nixon shock to play out through the system. Today, algorithmic trading and instantaneous global communication mean that billions of dollars can shift from one asset class to another in microseconds. The total value of global financial assets exceeds $400 trillion. Even a 5% reallocation in response to changing perceptions of risk and opportunity represents a $20 trillion wealth transfer, larger than the entire GDP of China. The Venezuela operation, by forcing a reassessment of fundamental assumptions about property rights, sovereignty, and the role of military power in economic affairs, has the potential to trigger exactly such a reallocation. Consider the position of a central bank in Asia or the Middle East sitting on hundreds of billions of dollars in reserves. For decades, the calculus was straightforward. You held dollars because they were liquid, they were accepted everywhere, and they were backed by the full faith and credit of the United States government, which in turn was backed by the world's most powerful economy and military. The Venezuela operation does not change the military part of that equation. If anything, it reinforces it. But it does change the calculation around predictability and respect for established norms. If the rules can be rewritten when it suits the dominant power, then perhaps diversification becomes more urgent. This drives demand for euros, for yuan, for gold, for anything that reduces concentration risk. As these central banks diversify, they sell dollars and buy alternatives. The impact on emerging markets deserves particular attention, because this is where some of the most dramatic wealth destruction and creation will occur. Many developing nations have borrowed heavily in dollars, assuming they could earn the local currency needed to service those debts through exports. A stronger dollar makes those debts more expensive to service, potentially triggering defaults that wipe out bondholders and devastate domestic economies. But the same fragmentation that threatens dollar debtors creates opportunities for resource-rich nations that can align with alternative power centers. A country with lithium deposits or rare earth elements that was previously dependent on Western capital and technology might now find willing partners in China, or a resource bloc that trades in alternative currencies. The wealth transfer here is not just between nations, but between different visions of how the global economy should be organized. The corporate sector faces its own reckoning. Multinational corporations have structured themselves around the assumption of a relatively open global trading system with predictable rules. Supply chains snake across borders, with components manufactured in countries chosen for their comparative advantages. The Venezuela operation, and the broader geopolitical fragmentation it represents, threatens this model. Companies may be forced to choose which bloc they operate in, unable to straddle both. This restructuring will create enormous costs, stranded assets, and lost efficiencies. But it will also create opportunities for those positioned to serve the new regional systems. A wealth transfer from globally integrated firms to more regionally focused operators becomes inevitable. For individual wealth holders, the implications are equally profound, but often less visible. Inflation, which tends to accelerate when commodity prices surge and currency values become unstable, acts as a silent wealth transfer from creditors to debtors, from savers to owners of real assets. If you hold cash or bonds denominated in a currency that is losing purchasing power, your wealth is being transferred to those who own assets whose prices rise with inflation. Real estate, stocks of companies with pricing power, commodities and businesses that can pass costs on to consumers, all become vehicles for preserving and growing wealth in such an environment. Those who fail to recognize this dynamic and remain in fixed income instruments see their purchasing power erode, effectively transferring their wealth to the more astute or better positioned. The geopolitical ramifications extend beyond economics into the realm of security and alliance structures. Nations watching the Venezuela operation must now factor in the possibility that resource wealth makes you a target rather than an asset. This could drive some toward nuclear weapons programs as the ultimate guarantor of sovereignty, further destabilizing the international order. It could drive others toward deeper integration with protective powers, accepting client status in exchange for security guarantees. Either path represents a transfer of autonomy and, ultimately, wealth, as independent economic policy becomes subordinate to security considerations. The technology sector adds another layer of complexity. The competition for dominance in artificial intelligence, quantum computing, and other emerging technologies is increasingly framed in zero-sum terms. The Venezuela operation suggests that access to the physical resources needed to build this technological infrastructure, whether lithium for batteries, rare earths for electronics, or energy for data centers, may be secured through force if necessary. This raises the stakes for the tech competition and potentially accelerates the bifurcation of global technology standards and platforms. Wealth will flow to those controlling the technology stacks that dominate their respective blocks. Looking toward what may unfold in the coming years, we can identify several possible trajectories, each with different implications for wealth distribution. One possibility is that the Venezuela operation represents an aberration, a moment of overreach that will be walked back through diplomatic settlement. In this scenario, the immediate market dislocations prove temporary, and the gradual managed decline of dollar dominance continues without dramatic disruption. Wealth transfers continue, but at a pace that allows for adjustment and adaptation. This seems increasingly unlikely, given the strategic importance of the resources involved and the difficulty of climbing down from such a dramatic escalation. A second possibility is that the operation marks the beginning of a more aggressive resource competition, with other interventions following in different regions. In this scenario, the world fragments more completely into competing blocs. Trade flows are restructured along political lines, and capital controls become more common as governments try to prevent destabilizing outflows. The wealth transfer accelerates as assets are repriced to reflect new realities. Energy producers, and resource-rich nations aligned with powerful protectors see wealth flow in their direction, while resource-poor nations dependent on open trade see their positions deteriorate. This path likely involves periodic crises as the new system is stress-tested, each crisis providing opportunities for those with liquidity and nerve to acquire assets at distressed prices. The third possibility, perhaps the most concerning, is that the operation triggers a response that escalates beyond economics into direct military confrontation between major powers. The possibility that China or Russia might feel compelled to demonstrate that resource grabs will be contested could lead to conflicts that dwarf the economic impacts we have discussed. In such a scenario, the wealth transfer is accompanied by massive wealth destruction, as occurred during the world wars of the 20th century. This is the outcome all parties should work to avoid, but the logic of great power competition has its own momentum. What seems clear is that the era of relatively stable, rules-based international commerce that prevailed from the 1990s through the 2010s has definitively ended. The Venezuela operation will be remembered as one of the clearer markers of this transition. The wealth that has been accumulated under the old system will be repriced, redistributed, and in some cases, destroyed as the new system takes shape. Those who recognize this transition early and position accordingly, whether nations, institutions, or individuals, will preserve and potentially grow their wealth. Those who cling to assumptions that no longer hold will find themselves on the wrong side of history's largest wealth transfer. The future belongs not to those with the most wealth today, but to those who understand how power, resources, and value are being reconstituted in a world where the old certainties have fallen away.